All additional quantitative disclosures specifically related to leases are found in paragraphs 842.2054 through 2057. Beginning with paragraph 842.2054, the standard states that for each period presented in the financial statements, a lessee shall disclose the following amounts relating to total lease cost, including both amounts recognized in profit or loss and any amounts capitalized as part of the cost of another asset, as well as the cash flows arising from lease transactions. So first, finance lease cost, segregated between amortization of the right-of-use asset and interest on the lease liability. Second, operating lease cost. Third, short-term lease cost, excluding expenses related to leases with a term of 1 month or less. Fourth, variable lease cost. Fifth, sublease income disclosed on a gross basis and presented separately from finance or operating lease expense. Sixth, net gain or loss recognized from sale and leaseback transactions. And seventh, amounts segregated between finance and operating leases for cash paid for amounts included in the measurement of lease liabilities, supplemental non-cash information from obtaining right-of-use assets, the weighted average remaining lease term, and the weighted average discount rate. So while that's a substantial list of quantitative disclosures, you'll notice that almost all of these items are already reflected in our lease schedules. We've calculated our finance lease cost broken out between interest and amortization, our operating lease cost, our short-term lease cost, and our variable lease cost. And we addressed the disclosure of cash paid for amounts included in the measurement of lease liabilities and supplemental cash information in our statement of cash flow series if you want more information on those topics. So the remaining items we still need to calculate are the weighted average remaining lease term and the weighted average discount rate. And those aren't very complex calculations. We'll walk through how to compute them when we build out our workbook for disclosure. So at this point, we've covered most of the quantitative disclosure requirements. But paragraph 842.2056 adds one more key item. A lessee must disclose a maturity analysis of its finance lease liabilities and its operating lease liabilities separately. This analysis must show the undiscounted cash flows on an annual basis for at least each of the first 5 years, followed by a total for the remaining years. And the lessee must disclose a reconciliation of the undiscounted cash flows to the lease liabilities recognized on the balance sheet. So we'll look at all of that as we build out our disclosures in our workbook. Then there are some disclosure requirements around related parties, which again we haven't covered in this series. That's another advanced topic. And finally, in paragraphs 842.2058 through 2050.10, the standard requires a lessee that elects any of the practical expedients, short-term leases, combining lease and non-lease components, or using the risk-free rate as the incremental borrowing rate, to disclose those elections. So to finish this episode, let's look quickly again at how American Airlines and Best Buy approach this in their 10-Ks. They do so in a similar fashion. In their accounting policy footnotes, American Airlines states that leases with a term of 12 months or less are not recorded on the balance sheet, indicating that they elect the short-term lease practical expedient. They also elect to combine lease and non-lease components for real estate leases. Then if we flip to Best Buy quickly, they take a similar approach, noting that they also elect the short-term lease expedient and the practical expedient to combine lease and non-lease components whenever possible. Then if we look at the lease footnote in American Airlines 10K, you can see how they present their quantitative disclosures. They list their operating lease costs, their finance lease costs separated into interest and amortization, and their variable lease cost. They also present their operating and finance lease right-of-use asset and lease liability balances, their weighted average remaining lease term and weighted average discount rate for each lease type, supplemental cash flow information, which some companies place in their lease footnote while others will place in a dedicated supplemental cash flow footnote, and finally their required maturity analysis with a reconciliation to the lease liability, with the first 5 years presented separately as required by ASC 842, along with a reconciliation from the undiscounted cash flows to the present value of the lease payments, which equals their total lease liabilities. And if we look at Best Buy very quickly, you'll see that their organization is nearly identical. They begin by breaking out their balance sheet values, then disclose their lease costs, noting that the costs associated with their finance leases are immaterial. They then present supplemental information, including the weighted average remaining lease term and the weighted average discount rate for their operating leases. Again, finance leases are immaterial. And finally, they present the required maturity analysis. So with that, we've now covered everything ASC 842 requires to be disclosed for lessees. In the next episode, we'll bring all of this together and organize the required disclosure information within our lease tracking workbook.